Gann's most profound secret, the very cornerstone of his legendary forecasting ability, was his discovery that time, not price, is the ultimate arbiter of market trends. He found that markets do not move randomly but are governed by immutable cyclical laws. He demonstrated that by understanding these time cycles, one could forecast future turning points with a degree of precision that defied conventional explanation. To him, the market was not a chaotic gamble but a divine mathematical construction, an orchestra where every instrument played its part according to a precise temporal score. This video is a deep dive into that secret. We will explore the philosophy and the mechanics of the time cycles that William Delbert Gann used to predict the future. This is not about a single magical formula, but about a profound shift in perspective, from watching the price to understanding the market's internal clock. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The entire philosophy of William Delbert Gann can be traced back to a single powerful conviction, one that he frequently quoted from the Bible. The thing that hath been, it is that which shall be, and that which is done is that which shall be done, and there is no new thing under the sun. For him, this was not a piece of abstract wisdom, but a literal mathematical law that was the key to unlocking the markets. He viewed financial markets as a direct expression of human nature, and because human nature itself is constant, the patterns it creates must also be constant. The emotions of greed, fear, hope, and despair are the same today as they were 100 years ago. These unchanging emotions, when expressed by the masses in the marketplace, create distinct, repeatable, and therefore predictable cycles of behavior. This belief was the engine of his legendary work ethic. He asserted that no man could expect to make a success without first studying the past. While his contemporaries were chasing tips and rumors on the trading floor, William Delbert Gann was in his office, often working late into the night, surrounded by historical records. He compiled charts of stocks and commodities that stretched back for decades, in some cases over a century. He was a market archaeologist digging through the layers of the past to uncover the immutable laws that lay buried within. He was not merely looking at old price patterns. He was conducting a scientific investigation into time itself. He measured the exact number of days, weeks, and months between major tops and major bottoms. He measured the duration of the bull and bear campaigns, the time of the secondary rallies, and the length of the corrective declines. Through this exhaustive empirical research, he made his foundational discovery. Market movements are not random. They are governed by what he termed the law of vibration. He believed that every stock, every commodity, and the market as a whole possessed its own unique vibratory rate. This rate, once discovered, could be used to project its future path. The key to discovering this rate was the study of its history. By identifying the dominant time cycles that had controlled a market in the past, he could project them forward to forecast its future turning points. He wrote, "The more you study past records, the surer you are to be able to detect the trend of the future." This is why his first instruction to any student was to acquire knowledge. Without the hard work of preparation and the deep study of history, any attempt at speculation was, in his view, nothing more than a blind gamble doomed to failure. His secrets were not revealed to him in a flash of mystical insight. They were earned through decades of meticulous scientific research into the cyclical nature of time. In the analytical framework of William Delbert Gann, time and price were not equal partners. He stated with unwavering conviction that time is the most important factor in determining market movements. This is perhaps the single greatest departure from conventional technical analysis, and it is the key to understanding his forecasting genius. He had discovered through his historical research that time could overbalance price. This meant that when a major pre-calculated time cycle had run its course, the market was compelled to change its trend, often regardless of the prevailing news or the apparent strength or weakness of the price action. To grasp this revolutionary concept, one must understand that William Delbert Gann saw the market as a body in constant motion, governed by cycles of energy. A bull or bear market is like a wave of energy that builds, peaks, and then inevitably dissipates over a measurable period of time. Once that time period is complete, the energy for that trend is exhausted. The market is then in a state of equilibrium, or what he called being overbalanced in time, and it is ripe for a reversal. The slightest pressure can then start a new wave of energy moving in the opposite direction. He wrote, "My experience has taught me that nothing can stop the trend as long as the time cycle shows uptrend. Nothing can stop its decline as long as the time cycle shows down. This principle explains a phenomenon that perplexes many traders: the market's tendency to go up on bad news or down on good news. From Gann's perspective, there is no paradox. If a bull market's major time cycle is complete, no amount of positive earnings reports, favorable economic data, or bullish news can prevent the new bear trend from beginning. The internal force of the expiring time cycle is more powerful than any external news event. The good news simply provides the final opportunity for the insiders to distribute their stock to an optimistic public just before the trend turns. Conversely, if a long bear market has run its course in time, a wave of negative news may fail to push prices lower, and may even mark the final bottom as the last of the panic-stricken sellers liquidate their holdings into the hands of informed buyers who know that the time for a new bull market has arrived. This is precisely why William Delbert Gann was able to make his famous annual forecasts, often predicting the exact dates of major turning points months or even years in advance. He was not forecasting the news. He was forecasting the culmination of the great historical time cycles that he knew would dictate the market's main trend. This understanding led him to one of his most important practical rules: never buy a stock simply because its price seems low, and never sell a stock simply because its price seems high. A stock that looks dangerously overvalued can continue to advance for many more months if its dominant time cycle has not yet run its course. And a stock that appears to be a bargain can continue to decline relentlessly if it remains locked in a bearish time cycle. The final decision to act, he taught, must wait for the time to be right. It is only when a market approaches a critical juncture in time that a trader should begin to look for a confirmation in price and volume. Time is the master clock, and the wise trader learns to trade in harmony with its rhythm. Having established the foundational philosophy that time is the supreme factor governing market movements, we now transition from the abstract to the concrete. A principle is useless without a method of application. William Delbert Gann did not operate on vague concepts. He was a master of mechanics who created a precise, structured toolkit for measuring and forecasting the market's temporal rhythm. He left a clear roadmap of the specific time cycles he had discovered through decades of tireless research. This is the practical heart of his method. We will now systematically explore the calendar and the cycles that William Delbert Gann used, starting from the shortest term vibrations and building up to the great master cycles that govern bull and bear markets over many years. This is not a theoretical discussion. It is a practical guide to the tools he employed to predict market turns with such remarkable accuracy. William Delbert Gann's analysis began with the smaller yet vitally important time periods that govern the minor and intermediate swings of the market. He understood that major campaigns were composed of a series of smaller harmonic waves, and by mastering the timing of these waves, a trader could position himself for the larger move. His research revealed a clear hierarchy of time cycles for reactions and rallies. The shortest of these significant periods were moves lasting 7 to 12 days. He found that after a market advanced or declined for this duration, it was often due for a minor reversal or consolidation. This provided the active trader with a time window to be on alert. If a stock had rallied for 10 consecutive days from a low, the Gann trader knew it was entering a high probability zone for a pullback and would be cautious about initiating new long positions. If a move extended beyond this initial period, the next critical time cycle to watch was 18 to 21 days. This period, approximately 3 weeks, was one of his most reliable indicators for the end of a normal corrective reaction in a strong bull market, or a secondary rally in a bear market. He stated, "Buy on a 3 weeks reaction or decline in a bull market when the main trend is up, as this is the average reaction in a strong bull market." This was a cornerstone of his practical strategy. It provided a clear, time-based rule for entering with the main trend. The move was then expected to extend further, with the next important cycle cluster being 28 to 31 days, or approximately 1 month. A rally or decline lasting for a full month was a significant event and often marked a more substantial turning point than the shorter cycles. As the duration of a move increased, so did the importance of the time cycle. The next major periods William Delbert Gann identified were 42 to 49 days, approximately 6 to 7 weeks, and 57 to 65 days. The 49-day cycle, being the square of 7, held a special significance in his work. A correction that lasted for 49 days was a deep and serious test of the primary trend. The 60 to 65-day period was even more critical. He described it as about the greatest average time that a bear market rallies or a bull market reacts. Therefore, if a primary bull market had been undergoing a correction for nearly 2 months, he knew it was approaching a major time support zone where a reversal was highly probable. Finally, he placed great importance on the 90-day cycle, or approximately 3 months, viewing it as a quarter of the year and a major division of time. A 90-day advance or decline often marked the culmination of a significant intermediate trend, setting the stage for a major counter-trend move. By committing these key durations to memory, from 7 days to 90 days, the Gann trader was equipped with a temporal map, allowing him to measure the maturity of any given swing and anticipate its likely termination point. Beyond these repeating numerical cycles, William Delbert Gann discovered that the market was subject to a powerful seasonal influence. Through his analysis of over a century of data, he found that specific months and even specific date clusters within those months had a remarkably high probability of producing a change in trend. This was not astrology, but a scientific observation of recurring patterns, likely tied to the rhythms of business, agriculture, dividend payments, and mass psychology. In his later works, he published this financial calendar as a guide for his students. He identified the periods of January 7th to 10th and 19th to 24th as critical times at the beginning of the year for trend changes that could last for several months. February, especially the 3rd to 10th and 20th to 25th, was of similar importance. He noted that significant turns often occurred around the spring equinox, from March 20th to 27th. The month of May, particularly May 21st to 28th, was highlighted as a time for major tops and bottoms, equal in importance to January and February. July, being the midpoint of the year, was another critical month for major reversals, second only to January in importance for producing changes in the primary trend. However, based on his exhaustive study of historical highs, William Delbert Gann concluded that September was the single most important month to watch for the culmination of a major bull market. He wrote, "These periods are the most important of any in the year, especially for tops or final highs in a bull market, as more highs have occurred in September than any other month." He advised watching the dates from September 3rd to 10th and 21st to 28th, with extreme vigilance after a prolonged advance. Conversely, his study of historical lows revealed that the greatest number of bear campaigns ended in the month of November, with July being the second most frequent month for major bottoms. By understanding this seasonal calendar, the Gann trader was alerted in advance to the specific times of the year when the market was most susceptible to a major change in its primary direction. The final and most powerful of William Delbert Gann's time cycle tools was the concept of anniversary dates. This was a cornerstone of his long-term forecasting. Through his historical research, he made a profound discovery. The market has a long-term memory. The exact dates of major historical highs and lows, such as the 1929 top or the 1932 bottom, were not forgotten by the market. Instead, they became powerful vibratory points that would often cause a change in trend on or near their anniversary in the years that followed. This principle applied not only to one-year anniversaries, but also to major cycles of 2, 3, 4, 5, 7, and 10 years or more from a significant top or bottom. In 45 Years in Wall Street, he provides a detailed record proving the value of this rule. He designated the 3rd of September 1929 high and the 8th of July 1932 low as two of the most important anniversary dates to watch every year for a change in trend. He then demonstrated how these dates consistently marked turning points in the subsequent years. For example, the high of the first great rally after the 1932 low occurred on September 8, 1932. The high for the entire year in 1933 occurred on July 18th, just 10 days after the anniversary of the 1932 low. The high of the secondary rally in 1933 occurred on September 18th, just after the anniversary of the 1929 high. This pattern repeated with uncanny regularity. The practical application of this secret is straightforward but requires diligent preparation. The Gann trader must create a calendar of all the major and intermediate tops and bottoms for the market or stock he is following. As these anniversary dates approach, he knows the market is entering a time window of high vibratory energy where the probability of a reversal is extremely high. This is not a signal to act blindly. It is a powerful alert that tells him when to pay the closest possible attention to his charts and other rules, to watch for the market's confirmation of a turn. This concept of anniversary dates was one of the keys to his legendary long-range forecasts. It allowed him to project critical turning points months and even years into the future, transforming forecasting from a game of guesswork into a science of cyclical repetition. To know the cycles of time is to possess a map of the market's future, a temporal guide to when and where the major turning points are likely to occur. But a map, no matter how accurate, is useless without the ability to read the terrain directly in front of you. William Delbert Gann was not a passive predictor who simply placed trades based on a date on a calendar. He was a master tactician who understood that his time forecasts, however powerful, required a final, decisive confirmation from the market itself. He never acted on one factor alone. His greatest secret was not just the discovery of time cycles, but the integration of these cycles with his equally rigorous rules of price and chart analysis. It is this synthesis, this confluence of evidence from the market's three key dimensions, that elevates his methodology from mere theory to a complete and practical trading strategy. The first and most critical layer of this integration is the combination of time with price. While time tells you when to expect a change in trend, price tells you where the great battles between supply and demand will be fought. William Delbert Gann discovered that market movements are not random but are governed by a precise mathematical harmony. He found that prices advance and decline in proportionate waves, and that the most powerful zones of support and resistance could be calculated as simple percentages of past price ranges. Of all these, he declared, the most important resistance level is 50% of any high or low price. This halfway point, whether it be 50% of an all-time high or 50% of the range between a major top and bottom, acted as a natural center of gravity for the market. Other critical percentages he used were 25%, 75%, and the divisions of 1/3 and 2/3. The Gann methodology reaches its peak predictive power when a major time cycle culminates at one of these pre-calculated major price levels. Consider the final top of the Great Bull Market in 1937. The Dow Jones Industrial Averages reached a high of 195.59 on March 10th. A Gann analyst would have immediately recognized this price level as being of immense significance. It was just above the 50% point of the 1929 all-time high of 386.10, which calculates to approximately 193.05. This was a massive, long-term price resistance zone. Now the analyst turns to his time analysis. The Great Bull Market began from the extreme low on July 8, 1932. The time from that low to the high in March 1937 was 56 months. This was the moment of confluence that he had been waiting for. A major time cycle was maturing at a critical long-term price resistance level. This dual signal provided an extremely high probability that a major top was at hand. It was not a guess. It was a calculated intersection of the market's two most powerful forces. The patient trader, having identified this window, would not be caught up in the bullish excitement of the final advance. Instead, he would be preparing to exit his long positions and look for the market's final confirmation of the turn. That final confirmation is the third leg of the tripod, the signal from the price charts. The time cycle provides the alert, telling the trader when to be vigilant. The price level provides the location, telling him where to expect the battle. But the actual trigger to act, the signal that the battle has been won or lost, comes from the price action itself as recorded on his charts. William Delbert Gann taught his students to wait for the market to prove that the trend had indeed changed. His primary tools for this confirmation were the 3-day and 9-point swing charts. Let us continue our 1937 example. As the market approached the 195.59 level in the major time window of early 1937, the Gann trader would be watching his swing charts with the utmost focus. At that point, the trend on both charts was still definitively up, defined by a clear pattern of higher tops and higher bottoms. To sell at this point would be to act on anticipation, a violation of his rules. He must wait for the market itself to give the signal. After the final high on March 10th, the market began to decline. Soon, it had a decline of 3 consecutive days with lower lows and lower highs, breaking the last minor bottom on the 3-day swing chart. This was the first warning, the initial evidence that the upward momentum was breaking. As the decline continued, it eventually broke the last significant bottom on the more important 9-point swing chart. This was the final irrefutable confirmation. The time was up, the price resistance had held, and now the chart had confirmed the change in the primary trend. It was at this point, and not a moment sooner, that the professional trader would act decisively, exiting all long positions and establishing short positions for the new bear market. This methodical 3-step process, time, price, and confirmation, is the very essence of the Gann trading strategy. It is a system designed to remove guesswork, eliminate emotion, and align the trader with the market's true underlying structure. In conclusion, the secrets of the time cycles used by William Delbert Gann are not found in a single magic number or a mystical formula. They are found in a complete, holistic, and scientific methodology for analyzing and forecasting the markets. His great discovery was that time is the primary organizing principle, the framework upon which all market movements are built. But his genius was in making this discovery practical by integrating it, at every step, with his rigorous analysis of price and confirmation. He taught that the market is a trinity of forces, time, price, and volume, and that the highest probability trading signals occur only when all three are in alignment. The path to mastering this approach is not easy. It is not a shortcut to riches. It is a path that demands what William Delbert Gann himself gave: years of diligent study, relentless preparation, and an unwavering discipline to follow a set of time-tested rules. He viewed speculation not as a game of chance, but as a profession, as serious and demanding as that of a doctor or an engineer. The trader must do the work. He must compile the charts, study the history, and learn the rules that govern market action. But for those who are willing to undertake this study, the rewards are immense. By learning to read the market's internal clock, by understanding the harmony between time and price, and by waiting patiently for the market's own confirmation, the trader can move beyond the realm of hope and fear. He can begin to navigate the markets not as a gambler tossed about by random waves, but as a skilled navigator who understands the tides, the currents, and the stars. This is the ultimate secret of William Delbert Gann, that through knowledge and discipline, any serious student can transform speculation into a profitable profession.